Bring in Tom Lee from Fundstrat Global Advisors. Tom, good to have you here. Obviously, you've made a real franchise of actually talking about the interplay of COVID and the markets and how you think it's best to play it and trying to handicap whether the market has already priced in the latest or the coming news. How are you treating today's market reaction, and what do you think about whether we should be taking this new COVID potential threat seriously as an economic event?
Hi, Michael and Sarah. First of all, happy Thanksgiving or happy post-Thanksgiving. I mean, it's, today's obviously a fierce reaction, and the markets are always going to be a little worried about things that change visibility and things that can cause policymakers to panic and then eventually consumers to panic. And today is a great example of that. The VIX has already risen 45%, and the 10-year has come down dramatically. So I would be in the camp that I think today is much closer to marking the actual tradable low. Our technical strategist, Mark Newton, has called for a 3 to 5% correction that was going to start and then end in early December. I would say this is the hallmarks of this is actually today. I mean, I'm not a scientist, but there has not been a variant of COVID that has actually truly change the direction of the economy. So I know this is very alarming, but investors need to take it in stride too.
Yeah, well, there's certainly no doubt about that. I mean, obviously, even maybe in the best case scenario, we have a couple of weeks where we're not really sure how to assess, the science behind this new variant and things like that. But do you think the market is also essentially reacting to, where it had been already? In other words, this is certainly a very direct excuse and a reason to drive this one-day market action. But do you actually feel as if when you see crude oil crack below $70 a barrel and you see a lot of these macro moves that seem as if they're kind of losing their previous trends or ranges, is that something that you feel as if can feed on itself?
Oh, yeah. It's Michael, that's a great point. Once a sellout starts, nobody can really determine the depth and, the fierceness and the speed. But today, the timing is awful. I mean, it's a shortened trading day in the U.S. with very few people actually at their desks. In Europe, it's a shorter session. I mean, if I was a policymaker and I was worried about oil prices and the SPR was kind of like a last bullet that didn't do much, this obviously helps make people panicked and it's causing oil to be lower. But do I think oil is $60 in 2022 because the economy has screeched to a halt because of this variant? I mean, it's possible, but what investors have to keep in mind is South Africa's vaccination rate's like 24%, and the number of cases reported is 2,400. So even though this new variant's a large share, it was the cases were over 30,000 in the summer. So it's look, policymakers are panicking, and generally when policymakers panic, that's when investors want to actually step in.
So just to be clear, you're saying buy the dip. What would you be buying?
Yes. I'd be, I mean, I don't want to sound like I hit the Jim Cramer button, but yes, I think we're still on track for a fierce December rally. I think it's going to be led by whatever is getting stop losses today. So, Art Cashin talked about this morning, the cyclicals, I mean, casinos and hotels selling off and retailers. I mean, these are companies that dramatically cut costs and they have huge demand, and investors, unless the entire world decides to buy bonds, stocks are still cheaper than bonds. You're paying over 50 times to buy a 10-year. You're paying, more than that, 65. You're paying 50 times to buy an investment grade bond. I mean, the S&P, at 20 times our 2022 estimate. I mean, it's still a bargain.